and you invest in $300 to $500 a month over a course of 40 to 60 years could really compound into millions of dollars. And then you can retire a millionaire. It's easy as one, two, three. And you can start investing with as little as $5 a month. Yes. This is how to get started invested in the stock market as a beginner. Hopefully, by the time we are in our 60s, going on 70s, 50s, even if we lock in and do as much as we can, we are millionaires. I know that's what I'm aiming for. So, friends, when it's time to retire, leave a legacy and a blessing for the generation that comes after us. Amen. I don't know about you, but I know that I want to leave something behind for my children and my children's children. Listen, all you need to start investing in the stock market is to sign up and get a free account, a free brokerage account on Webull, Fidelity, Robinhood. There are so many platforms that are available to you and they are completely free. You just have to sign up and create an account. That's it. And then you can start investing. In this video, I'm going to talk about, well, how you can get started and how easy it is to get started. And I'm going to try to explain and break down to you the different ways of trading, learning the difference between individual stocks and stocks that are grouped together like ETFs, mutual funds, index funds, and why people invest in ETFs, index funds, mutual funds. What's the benefit of them? We're going to talk about that today. And lastly, I'm going to be talking about stock terminologies. So first of all, what is a stock market? What is a stock market? What happens in the stock market? So this is a Google definition. The stock market is a platform where buyers and sellers trade stocks which represent ownership claims and on businesses. It includes both public exchanges and private trading venues, allowing investors, you and me, to buy and sell shares, small pieces of a stock. Essentially, the stock market serves as a network of exchanges where securities like stocks and bonds are bought and sold, facilitating investment and ownership in companies. So when you buy a stock, you buy a small share, a small portion of ownership into the company. Something that you need to understand about the stock market before you start trading in the stock market and buying and selling stocks and shares is the stock market is very much so easy to manipulate when it comes to news outlets, current events. The stock market is influenced by current events, news outlets, what's going on in the current world. Like if war broke out, certain stocks would go up, certain stocks would fall. So, what's going on in society, what's going on in the environment, what's going on around the world affects what's going on in the stock market. Okay? Stay with me now. Now that we know what the stock market is, and now we know how to start investing in the stock market, all you have to do is sign up on one of those free trading or brokerage accounts, and boom, you can start trading. Let's talk about day trading. Day trading is basically trading in the daytime. Typically, most day traders buy a stock early in the morning to midday and sell before the stock market closes. So, if you guys didn't know, the stock market opens a certain time in the morning and it closes in the evening. In the US, the stock market typically opens at around 9:30 a.m. and closes at around 4 p.m. Eastern Standard Time. Day traders trade on a day-to-day basis. So they buy stocks in the morning and sell it before the day ends, or they buy stock today and sell it early in the morning tomorrow. Day trading is not really recommended. This is where a lot of people lose money because day trading is basically like gambling. It's far better for you to invest a certain amount of money in the stock market for over a period of time, long term investment, over years and years and years, and then it will accumulate and yield a larger return versus day trading, where you can potentially, yes, make a lot of money, but then also potentially lose a ton of money in a very short period of time. Day trading very much is like gambling. Long term investing, which is what I'm really going to talk about today, and is really what I recommend and I'm encouraging, because that's what proves to be the most profitable and what proves to be the best for you and me financially than any other trading method. And then lastly, there's also shorting. When someone talks about shorting, what it means is an investor is betting against the stock market. So they're basically predicting that a certain stock is going to go down in value, and people make money off of betting against the market. What you only have to worry about is long-term investments. This is what's best. This is what stand against time and proves to give you the most back for your money. When people talk about the risks of investing in the stock market, a lot of them are talking about day traders and people who are riding the waves that just come and go. A lot of people are in the stock market, they make a lot of money off of day trading very quickly, and it's because it's like gambling. Dopamine is released and they get hooked onto this feeling that they get when they make a lot of money off of day trading, and as a result they don't know when to stop, and at a certain point they then lose a ton of money because day trading is exceptionally volatile. And the more volatility there is, the more chance you are to make a ton of money, but then there's also a greater risk involved. And if you want to build generational wealth, the best way for you to go is to invest over a period of time and allow compounding interest to do its thing and yield an exceptional return. After decades of investing in the market, you are going to sit down and set aside a certain amount a month out of your paycheck that you can invest into an ETF, a mutual fund, an index fund, and also singular stocks. And I'm going to right now talk to you to why people invest in ETFs, mutual funds, and index funds and individual stock. An individual stock is literally just you buying into one single stock. A ticker symbol, if you have never heard that saying before, a ticker symbol is what identifies a company in the stock market. So Amazon, most of the companies that you guys are aware of, well-known brands, are in the stock market and they're being traded publicly. Amazon, Google, Microsoft, Dell, Disney, all these companies and more, Apple, Tesla, thousands, hundreds of thousands of millions of companies are in the stock market and being traded publicly. And the ticker symbols represent are basically just what identifies the companies. Amazon's ticker symbol is AMZN. Microsoft's ticker symbol is MSFT. Apple's ticker symbol is AAPL. And these are really good individual stocks to be invested in always, because time and time again these stocks have grown over a period of time. So these stocks have been on the market for decades and years, and they have performed exceptionally well over the years. They are companies that we all know, use, and are so familiar with. They're well established companies. We know that they're not going to go, bankrupt anytime soon, and they're not going to disappear off the market anytime soon. They're good investments. And they have in the past performed well and has increased in value in the past, and we know that they're going to continue to increase in value. So these are good individual stocks to own. What are not good individual stocks to own are stocks like penny stocks. Pennies stocks are literally stocks that sell for pennies. And there are stocks that are from companies. There are penny stocks that have been around for like ever and have for some reason remained a penny stock. But some penny stocks are brand new companies that have just entered the stock market, and you might not have a long history on them to be able to prove or be able to gauge whether this is a good company to invest in or not, whether this company is going to grow in value over time or not, because it's brand new. The company itself might be brand new and might be figuring things out. You don't know if this company is making good profit. You don't know if this company is under good management and leadership. So you might not want to invest in it. Also, with penny stocks, they're extremely volatile. So the stocks can literally go up really high, which could potentially make you a lot of money, but then they can also go down really fast and go down like really, really, really low, really fast. And that can also cause you to be indebted for a lot of money. But one thing to know with the stock market is you don't make a profit and you don't take a loss until you sell. So, if a company that you're invested in goes down really extremely low, but you never sell that company and you hold it for years and years and years, long term investing, years and years and years and years, you hold this company, and after a few years of it going down low and struggling, it recovers and it grows. And eventually, after you holding this company for 10 years, you sell it, and the point that you sell it, the value that you sell it for is a greater value than what you bought it for, you will make a profit. So, because you held it through the times that it was struggling and it eventually recovered and went back up, and you sold it at a higher value than what you bought it, you make a profit. And so, you won't make a profit until you sell. So, until you sell, nothing is finalized. The thing too about penny stocks is penny stocks can literally be on the market one day and be off the market the next day. And it's because the company declared bankruptcy or because the company decided for whatever reason to withdraw all of their stocks. And so penny stocks are extremely volatile and extremely risky to invest in. Those are stocks you want to avoid. Other stocks you want to avoid are mid-sized to smaller size stocks of companies that you know nothing about. You have no research on these companies. You don't know if they have a good history. You don't know how this company is doing, no history on it whatsoever. You have no proof that this company is going to perform exceptionally well and grow in the coming years. They're not good companies to invest in. You always want to do your research before you invest into a certain stock. Those are what individual stocks not to invest in. Now I'm going to talk to you about ETFs, mutual funds, and index funds and why people choose them. So ETF, mutual funds, and index funds are literally set up all the same way. They're all pretty much kind of the same with certain things that set them apart, but they all are designed the same way. ETFs, mutual fund, and index fund, which is index funds is a type of mutual fund. They're all designed to give you a diversified portfolio. So when you buy an ETF or a mutual fund, you are buying shares, small pieces of a group of companies. So in an ETF, you'll see a healthcare stock, a motor stock, AI or technology, cybersecurity stock, oil stock, stocks from different industries, and sometimes there's international stocks, depending on what ETF you decide to invest in. So with ETFs, they basically give you shares of a bunch of stocks from different industries and sectors. And what that does is it lowers the risks of you being susceptible to the market's volatility. So what that means is if oil industry is doing bad, kind of acts as a series of checks and balances because your oil stock might be down, but your healthcare stock is still going up. Your cybersecurity stock or AI is still going up. Your other stocks are still performing okay or exceptionally well. And that protects your portfolio from being in the negatives. It's like it balances out. One is down, the other is up, or they're all doing good together. So that's why people invest in ETFs, mutual funds, and index funds. It's a way of diversifying your portfolio. When you invest in the stock market, you never want to put all your eggs in one basket. You always want to have diversity for the very reason that I mentioned. When one industry is doing poorly, the other industry is fine and is doing well or is going up. If you put all your eggs in one basket and you only invest in oil stocks, if the oil industry is doing bad for whatever reason, the economy is bad, oil stocks are down, whatever it is, your portfolio will be in the negative because all you have are oil stocks, and the oil industry is not doing well. But if you have a diversity of stocks, the oil stock is not doing well, but your healthcare stocks are doing well, but your automobile stocks are doing well, but your AI stocks are doing well. And so it like balances out. So, what I want you to take away from this is you don't need to learn a lot and know a lot about the stock market to actually benefit from the stock market and to invest in the stock market. You just need to know a few things and you're ready to go, literally. Last thing I'm going to talk about are terminologies that you might hear when people are talking about the stock market. So I've talked about ticker symbols, we talked about ETF fund, mutual funds, and index funds are all literally a bunch of stocks from different industries and sectors grouped together in one, providing you a diversified portfolio. Or you could invest in an individual stock, which are always good. The stocks that have been performing well for decades prior, and they're going to continue to perform well. Um, Household name stocks, Walmart, Disney, Tesla, they're good to have and to hold for a long period of time. Also, before I talk about additional stock market terminologies, I'm going to talk about what compounded interest means in case that's also something that's kind of new to you. Compound interest is basically the interest that is accrued onto what you've initially invested into the stock market. So, when interest compounds for you, you invest like $5 into an ETF that has a certain amount. Different ETFs have different return rates. And so if you invest $5 and it has a good, it will, the $5 could potentially double. So it's just money that is being added onto or accrued onto your initial principal that you've invested. So it's money that you're earning on top of your money. It's your money making more money. Okay, so here are some terminologies that you might hear when people are talking about the stock market: bear market and bull market. What is a bear market and what is a bull market? So, a bull market is when generally a lot of stocks are doing well. So, a lot of stocks are trending upward and the prices are increasing. And this happens when a lot of people are buying into the stock, pushing the prices up. And so, what can cause that is good news. There's some sort of good news on the news station. A company posted their annual performance report, and they report good revenue or something, and people are confident in buying into the company because they're making good money and they're making good profit, and the company's under good leadership, and they're estimated to make even more money the next year. Then people feel more confident in buying into that company. um whatever is giving people confidence to buy into the market. A bull market is when people are just buying into the market and the prices are going up because everybody is buying in. Prices are going up. A bull market, in my opinion, is not the best time to start buying into the market if you're day trading. But we are long-term investors, so this kind of doesn't affect long-term investors. However, it could help you guys gain a perspective, more a great understanding of the stock market and how it works. So a bear market, if you buy in when the market is bear, so prices are higher than they usually are because everybody is buying in and pushing the prices up, everything is skyrocketing. You buying at a price higher than it's usually is at, and the market drops back down to its normal price, you've now lost money. Because if you sell, of course, nothing is finalized until you sell. But if you buy high and you sell low, you're losing money. If you buy low and sell high, you're gaining money, which is the ultimate goal in long-term investing, is to buy down when the stock is at a certain price and holding it for decades or years, 5 to 10 years, whatever time period you're choosing to hold that stock for, and then selling it when it's at a higher value than what you initially bought it for, which then yields you a profit. A bull market is prices are skyrocketing, everybody is buying in, people are confident, everybody is buying into the market. A bear market is the opposite of that. Everybody is selling their shares in a market and they're exiting the market. That, in my opinion, is when it's best to buy because you're getting more shares for less of a price. When the market goes up back again, then you can sell for an even higher price. Bear market means that the market is not doing so well. Everybody's selling their shares. Some bad news came out. Something is going on with the economy. People are fearful because remember at the very start of this video, which, by the way, go ahead and subscribe if you like so far the content that you're getting, the information that you're getting, and you're learning something from it. Go ahead and subscribe, comment down below how this is helping you. Go ahead and follow me on Instagram or TikTok if you can. But yes, the bear market, everybody's selling and exiting the market. Like I was saying before, stock market can be extremely volatile and extremely investors in a stock market a lot of times react to news, react to what's going on in current times and current events. So a news story coming out can cause a stock to go up if it's good news or go down if it's bad news. Last thing I want to leave you guys with is do not be afraid of investing. If you are young like me or not, it doesn't matter what age you are really, but if you are super young, you have time on your side, and it's best for you to start now and start when you are youngest, because that's when compounding interest really starts to benefit you. That's when you invest in $300 to $500 a month over a course of 40 to 60 years could really compound into millions of dollars, and then you can retire a millionaire and leave something for your children and the next generation after you, a legacy greater than yourself. Remember, guys, time in the market beats you trying to time the market. Don't be reactive to every news story, to everything that's going on in current times. Hold and sell later on. I hope this blesses you. Go ahead and subscribe. Follow me on Instagram. Follow me on TikTok. Go ahead and comment down below how this has blessed you. Thank you for watching. Bye. Good luck with investing.